During the global financial crisis of 2008 and 2009, public confidence in centralized banking evaporated. Customers lined up outside institutions like Northern Rock, realizing the systemic vulnerabilities of the traditional financial system. That vacuum of trust acted as a catalyst. In 2009, Bitcoin emerged as a decentralized alternative, a currency engineered specifically to operate outside the control of bankers and central governments. That single invention spawned an ecosystem of thousands of different digital instruments. But casually using terms like crypto and digital assets interchangeably creates a massive amount of confusion. This diagram shows the broad umbrella category, digital assets. A digital asset is simply any digitized asset that uses cryptography to secure its electronic form. Inside that broad container is a specific subtype, cryptoassets. These rely on distributed ledger technology, or DLT. It's a decentralized database where a network of independent nodes tracks and verifies every transfer, completely removing the need for a middleman. Conflating a general digital asset with a decentralized cryptoasset is dangerous. If an investor misunderstands the architecture they are buying into, they risk miscalculating their true exposure to risk. This taxonomy tree branches out from cryptoassets to establish our first pillar, cryptocurrencies. Designed to serve as a store of value and a medium of exchange, they exist independent of fiat money, but they are defined by extreme historical price fluctuations. Because that line swings so violently against a stable baseline of purchasing power, using these specific coins to pay for routine daily goods is highly impractical. To counter that, a second branch emerged in the early 2010s called stablecoins. They attempt to flatten that volatile wave by pegging their value directly to real-world assets like U.S. Treasury securities and commercial paper. But stability in this sector is not guaranteed. In the first half of 2022, the Terra USD coin collapsed catastrophically, proving that structural failures still happen. There is also a hidden contagion risk here. If a stablecoin provider is forced to rapidly liquidate its massive holdings of real-world reserves to meet customer withdrawals, it can trigger widespread panic across traditional credit markets. Attempting to tame digital volatility often just shifts the vulnerability. The risk moves from the unpredictable code of a cryptocurrency directly onto the balance sheets of traditional asset reserves. The third pillar in this ecosystem consists of tokens. Broadly speaking, a token is a digital version of an underlying cryptoasset. Tokens generally fall into two distinct groups. Security tokens operate like traditional financial instruments designed for investment, while utility tokens grant the holder future access to specific products or services. The final pillar represents a counter-movement, central bank digital currencies, or CBDCs. This is traditional finance adopting distributed ledger technology to issue its own digital fiat money. This completed diagram illustrates a critical distinction. CBDCs are indeed digital assets, but they bypass the decentralized crypto asset container entirely, returning ultimate ledger control to a centralized institution. Proponents argue this hybrid approach captures the best features of stablecoins, specifically faster payment settlements and lower transaction costs, without relying on private reserve backing. The digital asset space began as an outright rejection of central banking. Today, it spans a full spectrum of architecture, ranging from total anti-establishment decentralization to completely institutionalized central control. By bypassing traditional banks, investors choose to act as their own financial institutions. They take on the complete burden of operational hazards. Many users rely on online digital wallets. They offer incredibly fast trading access and easy connections to exchanges. But existing on a computer network leaves them highly susceptible to malicious hacking. The alternative is offline cold storage. Storing assets on an electronic device completely disconnected from the internet removes the hacking threat, but introduces the very real physical risk of the hardware being lost, stolen, or destroyed. Regardless of the storage method, the ultimate operational danger lies in the private key. Decentralized networks do not have customer service desks or password reset buttons. If an investor loses the private key required to authorize a transaction, retrieving those assets becomes virtually impossible. Even with perfect storage hygiene, the market itself poses a threat. If a coin suffers from low liquidity or security breaches, it can be abruptly discontinued or delisted by exchanges, immediately wiping out the value of the holding. Meanwhile, global regulators are scrambling to manage these hazards. The cross-border, largely anonymous nature of digital assets makes establishing a unified global regulatory consensus incredibly difficult. Digital assets provide a cryptographically secure method to store wealth, but that technical security demands a rigorous, unforgiving level of personal operational responsibility that traditional finance never required.